My next guest says rates have been too high for too long, and the economy feels fragile and vulnerable right now. And he is expecting the Fed, I should say, to cut 2 times this year. Let's bring in Mark Zandi. He's chief economist at Moody's Analytics. Mark, it's great to see. I thought the last time we talked, you were trying to convince me that everything was fine.
Well, everything is fine if the Fed starts cutting interest rates. I mean, if the Fed keeps rates as high as they are for a long period of time, it's a corrosive on the economy. It's going to do some damage. And, I sense that it's starting to do some damage. So far, no big deal. In fact, some of it might be to the Fed script, trying to cool things off and get inflation back in the bottle. But, the longer they keep rates here, the more likely something's going to go wrong somewhere, and we're going to get surprised to the downside.
So are you in the Goldman camp? I saw their note this week saying they think we're kind of at a turning point potentially for the labor market, more signs of cooling, and they also see 2 cuts this year. So it feels like that's what you're talking about as well.
Yeah, you can sense what I'm saying in the labor market very clearly. I mean, if you look at things like the rate of hiring, that's down. If you look at unfilled positions, still elevated, but way down from where they were. Hours worked are down. Quit rates are down. Temp jobs are down. The only thing that's kind of hung together really well and allowed for the job growth is layoffs have remained low. But as you pointed out earlier, they're up in the last 3 weeks. Now, it's still way too early to send off any kind of flares. But, if UI claims, initial claims for unemployment insurance keep pushing up, and that suggests more layoffs, then we're going to see much slower job growth. And here's the other thing, Kelly. We put together this tracking estimate for GDP growth based on all the data that's coming in.
Right.
And it's tracking in the second quarter about 1.5%, very similar to Q1. 1.5% growth is, it's growth. It's we're moving forward, but at a very slow pace. And that's why unemployment is starting to move higher. We're up about 0.5 point over the past year. So, all these pieces of data suggest that the economy is throttling back. It's under the weight of the high interest rates, and it's time for the Fed to cut rates.
One of the newer Fed members was out earlier this week talking about maybe a rate hike. What would kind of what's the significance of that? Yeah, to be honest, I think the market kind of shrugged it off. But there are those who have looked at, for instance, financial conditions. We've heard Neil Kashkari talking a lot about that, and the market again continues to move higher. So I think you could piece together the case of, hey, if we back off too quickly, there's the risk that inflation reignites in services or something like that.
Yeah, I don't get that at all. I mean, the stock market's up, credit spreads are in, but, the dollar is really strong. The banking system is tightened down very aggressively. Diana was just talking about that in the context of the home builders. Multifamily developers can't get loans, and so they're starting to pull back on their supply, which, by the way, goes to getting inflation back in. There's a whole nother, conversation. You kind of add all up. It feels like financial conditions are, exactly where you'd want them to be to get the economy, back to a place where inflation is coming back in. So, I don't understand that argument, and I really don't understand the context of the slowing growth and inflation coming back in. We are at the Fed's target if you exclude owner's equivalent rent, OER, the implicit cost of owning a home. And I really think in the current context, that's a better measure of underlying inflation, given the difficulties in measuring OER at this point.
Yeah, I mean, it's effectively kind of the cost of renting a single family home. But that market, all that and so forth. The Fed officials have said they want to see a few months of data of basically, 0.1s, 0.20s. We got that last month. Should they wait?
Well, that's why I think September rate cut, because that's what they're going to do. And I think they're going to get what they want. Should they wait? No. I mean, I think I would go. I mean, mission accomplished. We're at full employment. Inflation's back to target. Inflation expectations are nailed to the ground. The economy's growth rate is slowing. So, you add it all up and it suggests we don't need a 5.5% federal funds rate target. So I'd be cutting, but I'd be a lone voice on the Fed. They are going to wait 3 more months, get those inflation statistics that they need, and start cutting rates.
I was going to ask.